Hello and welcome to Business Today Television. I'm Siddharth Zarabi, and with me today is Neelkanth Mishra, Chief Economist at Axis Bank and Head of Global Research at Axis Capital. Neelkanth, good afternoon. Welcome to the show. I want to begin by asking you about your sense as far as the worries that were generated by the political stock exchange. Is the worst behind us now, and is that why the markets also seem to have calmed down quite a bit since yesterday?
Absolutely. And in fact, that was my view right off the block, that the verdict is strong enough for us to have a stable government for 5 years. And I don't expect much of a change, given that there is continuity in the government, that the broad economic policies will persist. The path to fiscal consolidation is also something that is likely to be sustained. So once the volatility of the day of results is over, I think people are also realizing that mainly markets are about forward earnings and price to earnings, and those things don't really change very quickly.
Absolutely. Neelkanth, do you think the markets misjudged, perhaps on account of lack of information as to the contours of Modi 3.0, the first avatar for Prime Minister Modi in a coalition of this sorts, and was that misjudgment on account of fears of losing control over the economic agenda?
See, I think the markets, because of the way the newspaper headlines and TV headlines work, I think maybe overestimate the impact of the central government on the near-term prospects of the economy and the markets. And now that they are finally realizing that the near-term momentum in the economy is dependent on what was done by the central government in the last couple of years, or what state governments are doing today, and that, say, for example, the turn in the real estate cycle is something that is going to sustain economic growth for the next few years. What perhaps the markets may be underappreciating is the impact that strong central government can have over the next 5, 10, 15 years in terms of the shape of the economy and all that. But frankly, given all the uncertainties in the market, it is very unlikely to be worried about those things very quickly. So perhaps the impact of the central government of a strong central government in the near term was overestimated, and now that realization that it was incorrect is sinking in, the markets are kind of gone back to where they were on Friday.
Absolutely. Almost 75% of the loss having been taken off, and you see a lot of green in the markets. Neelkanth, I know that our viewers would want me to ask this, and that question is, do you think there is a likelihood or a fear of the fiscal stance that has been a cornerstone of Modi 2.0 or even before that? Is that likely to change or come under pressure?
I don't think so. So this is something where there is a big divide in the markets. There are many people who think that the response to the electoral shifts will be that the government sort of goes back on its fiscal consolidation roadmap. I don't think so. In fact, my sense is that it's as important as the verdict is how the verdict is interpreted by the people in power. So as they sit down and analyze the reasons why results in certain states did not sort of meet up to expectations, they realize that it wasn't necessarily the fiscal stance, and therefore my expectation is that the fiscal deficit target in July, when the full year budget is presented for FY25, could actually be brought down versus what was presented in the vote on account. So the target was 5.1%. Given the surplus dividend that the Reserve Bank of India has given, which is almost 0.4% of GDP higher than what was budgeted, there is space for the government to actually bring down the fiscal deficit even more. And that should be very good for the bond market. So that's something where somehow our views are very different from what is currently prevailing.
Neelkanth, how much space?
So you see FY24, the fiscal deficit in the target in the revised estimates was 5.8% of GDP. What came out in the provisional numbers was 5.6% of GDP, so almost 20 basis points or 0.2% of GDP lower. The reasons why this happened included things like stronger dividends coming in from several public sector undertakings and better than expected revenues. Frankly, those trends should continue in FY25 and if not be better. In addition to that, if you must have seen, the Reserve Bank of India was expected to give, I think, about 85,000 crores of dividend in FY25. What they ended up transferring was 2.11 lakh crores. So that gap itself is nearly 0.4% of GDP. So there is adequate room for the government to consolidate even more than what we are suggesting. It is quite possible that they may retain some of the room to tide over the uncertainty, some of the uncertainty that may emerge on tax collection. So quite a bit of that surplus dividend from the RBI would be, in our view, passed through as a reduction in the fiscal deficit.
So perhaps we should factor in 4.7, 4.8 at this stage?
That is also possible, though the government may try to be a bit cautious. Remember that there are no rewards for being very aggressive with your fiscal targets and then missing them. So the governments tend to approach macroeconomic stability very seriously. So they may actually be a bit conservative and then target the 20 basis point reduction and not really a 30 to 40 basis point reduction. And then later in the year, as they announce the second half borrowing targets, they will be in a better position to assess if they should bring down the fiscal deficit targets at that time.
Absolutely. Neelkanth, let's switch gears to another point. And you spoke about the budget. I'll come to that briefly. But broadly, is the India public sector, public investment driven capex story going to taper off? We already had seen hints of that in the past year. Previous couple of budgets have also spoken about that. Is that a strong possibility? Because the manner in which the sell-off happened, although it was a broad-based sell-off, the sense that market participants had was that, it's going to be a big switch away from infrastructure into many other areas that might support consumption.
Right. So you see, the fiscal deficit or the fiscal spend on infrastructure, center and state combined, has risen quite sharply in the last 3-4 years. And this year, actually FY25, it is expected to be unchanged, especially at the central level. I think the guidance from the government has been, and very explicitly so, that going forward, the infrastructure spending is likely to be in line with the growth in nominal GDP. So infra spend on the fiscal front by the central government is not going to rise as a percentage of GDP. And the reasoning for that is also, I think, quite obvious. If you see the split of FY25 central government capex, nearly 20% of that is either transfers to states for doing capex, or which is about 13%, and about 7% is the new fund that has been created on funding deep tech R&D. Now, the fact that the government mandate at if you look at Schedule 7 of the Constitution, is only on roads, railways, major ports, and civil aviation and telecom. How much you can spend on that, I think they were kind of maxing out on that one. So the scope for growth lies only on railways, and given that the economy is starting to revive, I think the support that the government needed to provide fiscally is also not as necessary. So some kind of I would say normalization, where government spending on capex as a percentage of GDP flattens out from here after having risen very sharply, was to be expected. That was the plan, and I think that will continue. On whether the government will reorient some of that into in consumption, I think that also, I think, is unlikely, given that the policy that we have seen this government adopt over the last decade is of being fiscally conservative, trying to enable people to earn their own incomes, providing them with electricity, with roads, with affordable loans, with pakka houses, with toilets, with rooftop solar, and enable them to earn more rather than transfer income. So that philosophy, I think, will continue in the new term as well.
Neelkanth, so therefore, do you buy into this theory that seems to have been at play over the last couple of days, that it's time to perhaps rebalance portfolios, allocate capital away from some of these sectors that were running up on account of certain belief of government linkages towards consumption, pharma, FMCG? Do you sort of buy into that at a macro level?
So frankly, even before the election results, in our model portfolio, we were underweight industrials and overweight consumption. And the reasoning was exactly what you said, that price to earnings multiples, while we are very positive on the investment cycle, I think investment activity will be very strong in the next several years. And we also believe that given the slack in the labor market, the overall consumption growth may remain somewhat lower. And in any case, in a phase where the investment to GDP ratio is going up, the growth in consumption almost arithmetically has to be lower than the growth in investment. So this is something that we have been talking about and anticipating, and which is why we were underweight industrials and overweight consumption going into even the election results. And I see no reason why we should change that. So there was a very sharp move against industrials and in favor of consumption. And you're right, but so to the extent that the valuation gap starts to narrow, I think we are aligned with that view. But to the extent that people think that the government's fiscal stance is going to change and it is going to start spending more money and trying to boost consumption proactively, that view, I think, would not be correct.
What are the chances of state level capex improvement? And I am pointing towards two specific states which are also now key partners. In some ways, Modi 3.0 is triple engine ki sarkar. You have Bihar and you have Andhra Pradesh, and both have significant demands when it comes to state level capex in the form of state packages. Do you think in the medium term that would sort of feed into state level capex and improvement?
So state capex, if you look at the FY25 budgets that have been presented by the various state governments, remember that governments are very large organizations, and there is a certain process and protocol. There are leads and lags. So, for example, if the budget for FY25 is frozen, it was been approved by the Assembly, say in the month of March or April, then even if you start to amend it, the change will only be impactful in FY26, because it is going to be very difficult to midway inform the various ministries at the state level that now you have more money to spend and let's start spending it, because the government machinery, there is a certain cadence to how it works. Secondly, even over the medium term, I think given the fact that the 14th Finance Commission had discontinued as newspapers are reporting as well, had discontinued the practice of identifying states or giving them a special category status. This is not to say that these two states cannot be given specific packages, but in general, I think that the central government support for state capex has been quite strong in the last 2-3 years. The government has been transferring more than $1 trillion rupees every year. In fact, this year's budget is also 1.1 trillion rupees. And in fact, Bihar has been one of the biggest users of that fund. These are zero-cost long-term loans. that are provided by the center too. And I think some of these tools can be very handy. And in fact, most of these states, or even most states, this can actually be very productive, and I think would boost growth in the economy.
Neelkanth, why is private sector capex still weak? Is it on account of the fact that consumption, which accounts for half of India's GDP, is still stuttering, although within that you have pockets like luxury housing, high-end electronics, all of that is been doing very well, but broadly, is that the reason? And do you see any change as far as private capex is concerned in the short to medium term?
So, frankly, I disagree with the fact that private sector capex is weak. In fact, what we have been observing is that the order books for most of the industrial stocks we cover, the forward-looking earnings trajectory, in fact, almost every industrial stocks we cover, every industrial stock we cover, the 3-year earnings CAGR is in 20 to 30% range. In fact, and order books have been expanding. In fact, most companies have reported significant expansion in their order book, even in the March quarter. So that activity has actually been picking up. The narrative that this could actually slow down is something that I disagree with, because, see, if the economy is growing at 7% plus, I mean, assuming that the gross value addition growth, which was 7.2%, is the more sustainable trend, and that GDP was higher than that at 8% plus because of the fiscal accounting. So even if you're growing at 7%, there is a significant amount of capacity building that is needed, and across a range of sectors. And if you plot the slowdown in capex that happened between 2012 and 22, it was driven primarily by 3 factors. The first was slowdown in household investment in real estate. The second was investment in power generation. So we had seen there was a phase where you were adding 20-25 gigawatts every year, and then suddenly that slowed to 3-4 gigawatts. And the third was manufacturing capacity in things like metals and construction materials, which are also inputs to real estate. So if the real estate cycle revives, investment to GDP ratio will be much stronger, and that's exactly what we are seeing. So if you plot the GDP against the pre-pandemic path, the GDP is now in FY25 likely to be 6% below the pre-pandemic path. The gross capital formation, which includes inventories as well as investments, is almost at the pre-pandemic path. So the revival in investments has been actually very strong. And we are seeing that. We are seeing capex announcements by steel companies, by cement companies, by paints companies. In fact, someone was telling me that in the cables and wires market, that there is now likely to be a shortage of capacity because of all the construction that is starting off. So in any economy, and especially subcontinental economies like India's, the turn in the real estate cycle triggers off a lot of collateral effects. And I think that is starting to play out in India as well. So at an economic level, I think investment activity will remain strong for the next several years. I'm less sure about how to play that in the stock market, because some of these stocks are actually trading at very, very high price to earnings multiples.
Absolutely, and we've seen between yesterday and today a further shift in that. Yesterday, FMCG was for most part of trade the biggest gainer, and now it's in the red. Neelkanth, what are the priorities that or challenges that the incoming government will have to face? And I'm not asking you a 100-day agenda, because we don't know what it will be now in the changed circumstances, but from a budgetary point of view, how is the new government likely to approach the budget, and therefore by consequence the part of the economy that is impacted by it?
See, the budget, given that it is already July, or it will be July when it is presented,
yes,
and there is a lag. Again, as I said, these are large organizations, so even if some changes have to be made in the budget, so the previous budget was a vote on account, so clearly this will be a much more detailed budget with maybe some new announcements. But in terms of fiscal spending, I think it's very hard for any ministry to suppose, the budget is presented in July and then approved, say, end of July, early August, and then the various departments are informed. for them to plan to spend. Suppose someone's allocation is increased by say 50,000 crores. Anything smaller than that is not macroeconomically important, given how large our economy is now. So I mean, it's not very easy to spend that kind of money in a few months. So I think that from a budgetary perspective, I think announcing intent, announcing the fiscal consolidation roadmap, or maybe reiterating it, which is what we expect, or maybe announcing a faster consolidation. So those kind of policy announcements, I think, will be the biggest takeaway from the budget. From the priorities of the government, I think that globally, industrial policy is now back in fashion. There was a phase for 40, 50 years where the global economy was moving towards free trade. Trade barriers were being reduced, government interventions were being reduced, and now we're seeing a reversal of that. So, in China, for example, in the last 3.5 years, incremental lending in form of medium and long-term loans to industry has risen by nearly $1.9 trillion. And if they continue at this pace, there could be a commensurate or even a larger number which is disbursed to industry in the next 3-4 years. Now, with this level of aggressive investment, it is not surprising that many other economies like the US and increasingly Europe as well are starting to devise their own industry policy action, trying to create protectionist barriers or trying to support their local industry with fiscal intervention.
Including semiconductors, for example, Neelkanth. That's perhaps one of the biggest examples.
Absolutely. So the Indian government also has a semiconductor policy. So we've very successfully kick-started the process. The first few proposals have been approved, but maybe more is needed. And given the level of expenditure that is happening globally, it is possible that several other industries in India will also need support or some boost so that they can catch up on the technology front. So that will require, I think, a cohesive approach from within the government. Various ministries will have to work together. And I think that would be one of the biggest challenges in terms of even news flow over the next several years. The second biggest issue, in my view, is the issue of urban infrastructure. So the real estate cycle is in a good shape right now. It is turning. The last 2 years have been very strong, and these cycles generally last a few years. But for them to last many more years, it is extremely important to build a lot of urban infrastructure. That is how cities can expand. That is how cities become efficient. And while some of the bigger cities are starting to solve some problems, I think we need to solve these problems for 500 to 1,000 cities. And for that to happen, we need to find avenues for providing funding to them, giving them access to fiscal resources, which they can leverage then and start to use maybe the municipal bond market. But for that, they need to see some revenue clarity or visibility. So maybe this can be done through various government bodies or even the Finance Commission. But either way, this also, I think, should be, and here I'm being totally prescriptive, should be a very high up on the government's priority list.
Absolutely, and just to add a small word from my side on that, I think within the real estate pack, which by the way, viewers, is the top gainer as we slip into the last hour of trade today, is affordable housing. Because Neelkanth, you will agree with me that while you made this very important point about urban infrastructure, one of the key things is that everything that is being built, and as our cities, mega cities expand, is very high end, and in the middle, therefore, we are seeing a supply crunch and very high prices, and that's impacting society in many ways more than one. As we wind down, I just want to ask you that in all of those priorities, would it also make time for the state, and by that I mean both the center and state governments, to perhaps ramp up investment in filling up the capacity gaps in healthcare, for example? We have far lesser doctors than what we require, teachers, cops, and that will in itself also drive a lot of economic growth as a result.
No, absolutely. So I think the priority as we think about the 2047 target of Viksit Bharat, the adults in their prime working age in 2047 are the kids of today, and so the healthcare that they get, the education that they get, I think is extremely important. And this, I think, should continue to be an area of prime importance for both the state and central governments. Both of these areas are primarily part of the state subject. But for some of the states that have been lagging behind, I think definitely there is a lot of work to be done there.
One final question, and I want you to answer the doubts that have crept up that although the Modi government was very cautious on some of those so-called radical reforms that the markets expected, should we give up on expectations of radical reforms or things that are long-term in nature? For example, Agniveer, where one of the allies has already formally called for it to be reviewed. So broadly speaking, will some of the big ticket reforms that were expected, perhaps not by the government but outsiders, are they likely to be impacted?
So, you see, there are three levels of change that any government can bring about, right? The first is constitutional amendments, the second is legislative changes, and the third is executive action. Now, given the scale of the mandate, the constitutional amendments now become much harder, right? Because you need two-thirds majority in both houses of parliament, and if it affects state government functioning, you need 50% of state legislatures to approve as well. Now, with 293 seats, I think that becomes much harder to do, even if there was a desire to do that. But the ability to pass laws, which is, so if you have a majority in the Lok Sabha and the government and the NDA has 49% of the seats in the Rajya Sabha, and with the victory in Andhra Pradesh and Odisha over the next 2 years, maybe they'll get more seats. And even if not, there are several non-allied parties which have meaningful presence in the Rajya Sabha, which can be used to pass laws. So I think the legislative ability of the government remains intact. And then when it comes to executive action, so when reforms have to be undertaken, suppose something like Gati Shakti. Now the problem that ports, roads and rail, the capacity should be planned together. So you can't really be building a port without rail connectivity or a rail hub or rail head without road connectivity. It's something that we've known for a long time, but these were independent ministries. But what we have done is through the Gati Shakti initiative, got them to collaborate, and therefore our infrastructure has become much, much more competitive and much better coordinated. Now, this required no change in laws or constitution, but still has had a meaningful impact on how our infrastructure is planned. So there are many important and necessary changes that can be brought about just through executive action. So, and many of those initiatives are underway. Remember that this is where government continuity helps, that there are several schemes. See, anything which is very large takes several months, quarters, years to implement. There are several schemes which are sort of halfway into the implementation, and the continuity in the government helps provide visibility on their completion.
Absolutely, and this will be watched very, very closely now on the budget and even beyond that. Neelkanth Mishra, thank you very much for joining us at a time when we've told the world that India, there's no anarchy, no disturbance, almost 1 billion eligible voters, and we've sent out a message globally that we are a robust democracy, and if people are looking towards India and our investment potential, our democracy is at the base of that, at the core of it. As always, thank you very much for your time with us today. Viewers, we'll slip into a short break and we'll come back with closing our trade. Do stay tuned in.
Narendra Modi in his third term will be batting on a new pitch. From 2014, Modi has been heading